Morning, everybody, and welcome to the Financial Inclusion Week. Super excited to be on this panel here today with a great list of panelists, and we'll be discussing financial inclusion and particularly the World Bank's Global Findex report, which was recently released. I'm joined by a great set of panelists here. We have Leora Klapper, the lead economist at the Development Research Group at the World Bank, who led the report. We also have Sophie Sirtaine, CEO of CGAP, which focuses on financial inclusion and advocacy, a DC-based think tank. And we have, of course, Michael Schlein, President and CEO of Accion. And lastly on the list, we have Bindu Anant, Chair and co-founder of Leora Holdings. Thank you so much for joining us on this session. Looking forward to dig deeper into this conversation on the World Bank's Global Findex report. And just to give a bit of background into the report, it was published, updated in July, and it's the World Bank's most comprehensive data set on how people are accessing financial services across the world. First published, I believe, in 2011, and it has continued to provide the world with a deep understanding about how people are accessing these tools, financial services, and how it's building resilience across the world. We're going to dive in deeper into some of the things, some of the key talking points or takeaways from the most recent update in July. We're going to be joining Leora Klapper, who was the lead author of the Global Findex this time, and along with CGAP CEO to discuss some of the key takeaways from the report and how countries are evolving as financial inclusion begins to take root, led by mobile money and other type of digital services. So with me starting off the conversation, I want to introduce Leora Klapper to join us on this conversation, and then we can start digging deep into the Global Findex report. Thank you, Leora, for joining us.
Thank you.
So starting up high level, we've seen a lot of changes with the Global Findex report since it was first published in 2011. And a number of things, a number of highlights from the most recent report obviously has been the significant growth in terms of access to financial services in low and middle income countries. We've seen that grow significantly, particularly on a country by country level in places like, for example, India, where it has jumped from 30% to as high as 90%. And so I'm curious about some of the things that are driving this transformation and some of the key things that you found over the last decade, particularly with the July update in particular.
Yeah, so thank you. Financial inclusion really is a bright spot on the global success story and global success stories. So over the past decade, access to formal financial services has expanded really fast, especially for women, low-income adults, and people are now using a wider range of services like digital payments, savings, and credit. A lot of that progress comes down to the spread of mobile money and digital technology. I think an interesting point is that we're not really seeing one model driving the success. It really depends, as you mentioned, a lot on the local context. So the Global Findex looks at how people actually use their accounts, but these experiences also reflect the supply side, things like regulation, competition, and what fintechs are allowed to do. So if you look at sub-Saharan Africa, for example, there are countries like Ghana, Uganda, where mobile money is becoming people's only account, and even replacing traditional bank accounts. But other places like Nigeria, South Africa, mobile money tends to complement the bank accounts because the regulations are more bank-led. And mobile money isn't even just an African story. We're seeing the growth of mobile money growing very quickly in Latin America, with fintech apps being used on smartphones, helping people bank from home. In China, we're seeing 80% of adults making digital payments directly from bank accounts using fintech platforms. So I think a major takeaway from the data is that it doesn't really matter whether you're using a bank or non-bank. It's really access to these greater, much more affordable, convenient, trustworthy accounts, helping people better manage their money and build resilience.
Thank you so much for that. That's quite fascinating. And one of the key things that you mentioned too is the fact that mobile phone ownership is one of the biggest drivers of financial inclusion in the last decade in particular. I'm curious about what that means in terms of whether or not does that mean that people are moving away from traditional providers of finance to more fintech-oriented solutions or more a different kind of solution? What does that mean for the traditional providers of finance in these markets?
So we, as I mentioned, we're seeing different models expand. We're seeing in some countries in sub-Saharan Africa, bank account ownership actually falling, whether it's new users are only adopting mobile money accounts, or people even replacing their traditional bank accounts. Mobile money offers people, especially poor adults in rural areas, access to this more convenient and affordable financial services. It also, the whole cost structure is different from a bank. Whereas the mobile money cost structure is typically there are no fees on depositing money or sending money, only on the withdrawal. Whereas a bank may have monthly payments, monthly fees and charges. And so for poor adults who are making, referred to as more low value, high frequency payments, mobile money may simply be a more affordable and appropriate model.
That makes a lot of sense, and it's one of the key drivers of should I say, mobile payments on the continent, the ubiquity of smartphones and regular phones too. So I want to dig deeper into some of the other trends that we notice, despite the fact that we've seen this adoption of financial access across key markets. We still notice that a large number of people in low and middle income countries still do not have access to financial services. And so we're trying to understand, like, what exactly are some of the issues that are holding folks back, on the one hand, from being fully integrated into financial services. On the other hand, we've also noticed that even for folks who have access to financial services, saving rates is still relatively low in these markets. I think about 40% of people in low and middle income countries have access or are saving with banks or any kind of financial services provider. What can you walk us through in terms of what's happening here? And is this disparity worse across genders in the markets that you've paid attention to so far?
So I guess as an optimist, 40% is a 2/3 increase from 2021. So the trends are positive. But a hugely important question is, recognizing that though we've made tremendous progress, there's still a long way to go. So there still are about 1.3 billion adults without accounts, and more than 700 million of them are women. And it's much harder to reach this last mile, these next billion. They often live in remote areas, face higher costs, and are much harder also to serve profitably. So we see three main barriers. The first are the foundational barriers, like lack of ID, weak mobile coverage, just a high cost of phones and data. And so in new data that we collect this year, we find that women are still 9 percentage points less likely to own a smartphone, and cost is the top reason. As you mentioned, many adults in sub-Saharan Africa have basic phones, which is enough for a mobile money account, but increasingly access to smartphones is important for the advanced financial tools and the digital economy. So the second barrier we see are the behavioral barriers. So for people living on daily income that's paid to them in cash, formal financial services can feel unnecessary. So these products have to match how people actually live. As I mentioned earlier, these small value, low fee accounts, things like flexible savings and apps in local languages can all help people with savings. And third, it's important to note the importance of trust. So people need to believe their money's safe, that the fees are fair and understandable, that they have recourse if something goes wrong. So what's working? What we really see is digital payments, the major entry point. So not only in sub-Saharan Africa, as you mentioned, mobile money, making P2P payments ubiquitous, we're also seeing now in developing economies big progress in the digitalization of payments. So 3 in 4 government payment recipients, about half of private sector wage workers are now paid directly into their account. And sub-Saharan Africa, so we're finding that almost 1 in 4 adults saving using their mobile money accounts. And so I would say the most important payment is to oneself. And mobile money is allowing a more convenient way to make digital payments to themselves, which is double the rate that we saw in sub-Saharan Africa of people saving in 2021. So going forward, the best way to expand both access and usage will be to pair people's greater access to the phones, to connectivity, with the products that people find useful and trustworthy.
Thank you so much for that, Leora. We really appreciate your insight on that. We're now going to welcome the rest of our panelists into this conversation. Sophie, Bindu, Michael, thank you so much for joining us this morning. I want to get your quick reactions to, high-level reactions to the Global Findex report. A lot has changed. Leora has walked us through a few things that have changed and a few things that are evolving really quickly too, and some of the things that countries have made progress in. What are your high-level reactions, and are there any surprises for you with the latest report so far? I'm going to start with you, Michael.
First of all, it's great to be on this panel. It's a great group, and congratulations to CFI for Financial Inclusion Week yet again, always getting stronger. I'm going to echo some of what Leora said. First, if you look back over since 2011, we as a movement have made remarkable progress, and we should really celebrate that. More than 1 billion people have gained access, which of course is an enormously important first step, but only a first step towards really participating in the global economy. The thing that caught my eye that I'm very excited about is the surge in savings. Today, 40% of adults in the developing world are saving in a formal account. That's a 16% increase in the last 4 years. That is really, really important when and half of them are saving every month. So they're really using these accounts. Then if you add back informal and semi-formal savings, the rate grows to 65%. So 2/3 of adults are now saving on a monthly basis. I think that's critical. I think that's exciting. I think that's core to the theme of this whole conference around resilience. And it's good to just dig one level more. Why is this happening? Because it's so much easier to save today than ever before. Used to be you had to go to a branch. You had to go to a branch to put your money in. You had to go to a branch to get your money out. Now you can do it on your phone. So of course it's so much easier. It's so much faster. It's so much cheaper. But it's really, really exciting to see the surge in savings. A couple of other highlights, but let's open up the conversation to some of the other panelists.
Yeah, thanks so much for that. Bindu, looking at Yoi.
Sure, thanks, Abubakar, and great to be here. Also to say that it's so valuable to have the Findex data that lets us have this conversation, benchmark our progress as a community. So really kudos to Leora and her team. I will say that while there is a lot to cheer in the data, and agree with Michael and Leora on that, I want to point out 2 things that concerned me and that really stood out for me. One is on the borrowing side. I really sort of interpreted the data as saying that the formal credit system in most low-income countries, including India, is marginal. It's still very much a sideshow compared to the informal sort of sector. 15% of borrowings in low-income countries, 25% in India happens from the formal sector. So that's just, I think to me, it's a bit of a paradox. There's been a proliferation of lenders, not just of the traditional variety, but also, of course, fintech lenders. Why aren't we making a bigger dent on the credit delivery side? And certainly from my vantage point, that is so integral to thinking about how we feed into the broader kind of economic growth story, et cetera, in our countries. And also interestingly, as we speak, India is going through a significant shrinking of its microfinance market, driven ostensibly by over-leverage. And just in the past year, for example, 15 million borrowers have dropped out of the formal system because of tighter credit norms. So this sort of, coexistence of pockets of overheating while the broader credit landscape remains severely credit rationed, dependent on informal sector, I think needs to be understood better and solved for. And, how can we get sort of just better spread of credit activity? That's certainly, I think, top of mind for me. The second one I will talk about briefly is just, I think the persistent vulnerability to emergencies, financial shocks that the Findex data brought out so well. Most people cannot manage even 2 months of expenses in the event of a job loss or income shock. And it strikes me as the nature of jobs change across the board due to shift out of farming in countries like ours, but also at the other end of the spectrum, impact of AI, etc. This really feels like a critical issue. And at least my own view, Abu Bakr, is that this cannot all be in the realm of financial inclusion. At some point, we need to bring social security into the conversation and to think about how do we really address this precarity that seems to be pretty widespread. So we'll stop with those observations for now.
Thank you so much, Bindu, for that. Sophie, I know you have deep thoughts on this and looking forward to your reaction.
Okay, sorry, I could not unmute. Thank you very much, first of all, for having me. And yes, a few thoughts that I'll share at the outset. First, of course, like Michael, like Her Majesty and Leora, I think we have to celebrate the progress that has been achieved. And a lot of the people who are listening to these conversations have contributed to this. And so I think we have to be mindful of that, in a way, initial success. But I say initial because I think there is no time for complacency, and that's really my main observation from Findex. On the one hand, as Bindu said, we still have 1.3 billion people without any account, 1.6 who are not using their account, and many of them are really in precarious livelihoods in rural areas, excluded from other infrastructure, voice, economic opportunities, and really this is a big gap that we need to continue to close. But my main observation, what really struck me, if you want, from reading the results, is really the fact that financial inclusion is always meant to be a means to an end, and that end is prosperity, resilience, financial health. And what Findex gives us this time is many more indicators of outcomes. And it just confirms that we are not there yet, indeed, as Bindu and others were saying. Indicators of financial health in particular remain very low, with only 55% of adults in the world, for instance, that say they can access emergency funds within 30 days. And so even with a surge in savings, that number has not increased. Many people worry about monthly expenses, many people worry about retirement savings, etc. But one thing I want to point out is that we did a very interesting comparisons between EAP, so East Asia and the Pacific, and South Asia, because there is a 50% difference in the percentage of people who say they could access emergency funds between these two regions, 78% in EAP versus 31% only in South Asia. And if you look at the reasons, of course, there is no causality here, it's just an observation at this stage, but the percentage of people who use different types of financial services is significantly higher in EAP than in South Asia, including the percentage of people who save, which is about twice as big, the percentage of people who use digital payments and so can receive remittances, transfers, again, about twice as high, 80% versus 44%. For savings, it's 59 versus 24%. Insurance, 41 in EAP, 9 in South Asia, and borrowing, 34 in EAP, 14 in South Asia. So for me, there is something around the fact that really to build resilience, one needs not just an account, we knew that, but really a palette of financial services. And that's what we need to continue our work to make sure that all people have access to insurance, credit, savings, pension, as and where they need.
Thank you so much, Sophie. I know that CGAP has, I believe, the Access Impact Pathfinder that goes deeper into outcomes, or should I say financial inclusion outcomes. And so that is quite, looking to touch on that in a bit. But Leora, I want to come back to you now. So this year's Findex report includes a range of data on financial health, and a few of our speakers have mentioned this already. And one of the key things that was new is business borrowings. And so what are some of the things that you've learned from the data about how people are leveraging financial access to achieve greater financial resilience? Sophie just mentioned about people having challenges to access emergency funding, and even among that pool of people who have access to emergency funding, a large number of them access it through family and friends. What does the data show us about how people are building financial resilience so far?
Thanks. This is such an important question, and why it's so important that the theme of this year's Financial Inclusion Week is around resilience. As you mentioned, we have an expanded financial health module, which was developed with the help and nudging of CGAP and the UNSGSA, which really gives us a fuller picture. So not just who has an account, but how people are using it, to manage their money, cope with shocks, and really plan for the future. And I think the biggest finding is that there's a disconnect between people's worries and the financial tools they're actually using. So as you said, many adults in developing countries say that they worry about running their business or medical emergencies or old age, but very few are using the financial tools like insurance or retirement savings or borrowing or able to access formal borrowing for their business. So these gaps, again, reflect both supply side issues. Products may not be designed for low-income users. Insurance is costly, complex, and access barriers. So, for example, small business owners often don't have the collateral or credit history that they need. And when we look at the resilience data, Sophie highlighted, this disconnect is even sharper. So savings are still the most reliable safety net. And even though formal savings has grown by 2/3 since 2021, only about half of adults say they could raise extra money in an emergency, and most would still turn to family and friends. And so we have new data, in addition, that finds that about a quarter of adults in developing countries were exposed to extreme weather event, and 2/3 of these adults lost income or property. And very few of them also reported making payments for insurance. So it really comes down to that accounts alone aren't enough. We need to make savings easier and more rewarding. Think about automatic deposits or interest payments. And this can really strengthen people's ability to both weather their shocks and build this long-term security that they need.
I want to quickly bring in Michael. You wanted to add a point on the gender gap, and
I just wanted one other high-level observation, which is a little bit tucked into the data. For so many years, since we've had the Findex, the gender gap was stuck at 9%, and it was enormously frustrating to all of us. And then in 2021, it narrowed to 6%, which was very exciting. But when you dug into it a little bit, it was largely because of India. And today, in this most recent Findex, the gender gap has gotten narrowed from 6% to 5%, which doesn't seem very much, but hidden underneath that is much more widespread progress. Last time it was all India. Now it's entire regions, East Asia, Pacific, India, have essentially eliminated the gender gap entirely. Now, that's the good news. There are countries that have 20% gender gap, so there's much more work to do. But yeah, underneath here is some widespread progress, which I think is one of the headlines that gets lost in the Findex.
Thanks so much, Michael. I want to dig deeper into the topic of resilience, which is the main, the takeaway, or should I say, the theme for this week's Financial Inclusion Week. We're going to dig deeper into this. And so the first question I have is, back to you, Leora, like, how do you define resilience for people who are just listening in for the first time, hearing about how it's being used in the context of financial inclusion? What are the key things that people should know when thinking about resilience in the context of financial inclusion?
So it's a good question, a hard question. So we measure resilience in different ways. One is certainly this basic question that's been used in the US and elsewhere. If you had an emergency, could you come up with extra money in 30 days? And what would be your source of money? We added an additional level of nuance because after piloting, for example, in India, where most women said, I would depend on family and friends, when I asked them, what were the circumstances? They said they'd ask their sister. And I said, well, how likely is it your sister will actually send you the money? And inevitably, the woman replied, oh, her husband would never let her send me the money. Or she also is suffering the same, suffering from the same drought or other event. And so we added this additional nuance on how reliable would it be? And so once we see that most people depend on family and friends, and most of that money would be very difficult or impossible to actually get during an emergency. The second set of questions we ask is about your biggest financial worry. What keeps you up at night? We added this question in 2021, coming out of a global health pandemic. Not surprisingly, the biggest response was health emergencies. Although even in 2021, across sub-Saharan Africa, in about half of countries, the biggest financial worry were school fees. And so, really highlighting the challenges that people face. I'll add an additional point on the school fees. We've been doing some work in Benin, for example, where we found that huge interest in making school payments using mobile money accounts. And I thought that it was simply that it's easier to crowd in money, right? So you can ask your brother in the city to send the money directly to the school. In fact, what parents continuously told us was the fractionality. That's a great benefit of mobile money. That when you go to the school, they require a minimum payment to use the administrator's time. And they wanted to send a little bit of money every day, every week to make those school fees so that their kids can stay in school. And really showing, I think both stories highlight that poor adults really, think about their money, and giving them the financial tools that are easy and affordable and appropriate to use can better manage their money and build their financial resilience.
Thank you so much, Leora, for that. Really appreciate it. Pindo, I want to come to you. There's a question that we have that I've been thinking about. And you mentioned this already too. So access to financial services is only the first step towards building that financial resilience and meaningful inclusion. How have you seen organizations working towards moving clients through that journey to get them access or greater access to financial resilience and financial services? I say this in the context of while we've seen that growth in financial services across emerging markets and lower and middle income countries, we still have the same concern about access to credit, about access to certain types of insurance also. How have you seen that companies are moving their clients along to ensure that they get this greater bouquet of financial services in a more streamlined way?
Sure. No, I was really struck by Leora's comment on, there is a significant disconnect between what people are worrying about and what they are using financial services for. And I think that's a bit of an indictment around, the kind of products that are available and what the supply side has done. So just to speak a little bit about what we are doing about this in our organization, Dwara, we are actually building a lot more bundles of services that are integrating financial services with sort of other adjacent requirements that customers have to really sort of address this kind of issue around translating access into usage, right? That's been a real kind of thorn for all of us. And here we are thinking about markets like healthcare, agriculture, dairy. So as people already mentioned, I think many respondents say they worry greatly about health expenses. At the same time, we know that standalone health insurance, despite a lot of policy push, regulatory diktats, etc., has seen very poor take-up across the board, certainly in markets like India. And we think this needs to be completely reimagined for the clients and the markets that we are interested in. So just to give you an example, something that I'm personally spending a lot more time on these days is at the intersection of financial services and health. And we've, for example, developed a health subscription product, which in a way is combining financial services. You can get a loan from us, you can access insurance from us, but importantly, the subscription also gives you access to some kind of tangible care. So some primary care, some navigation support if you need hospitalization, things like that. And I'm really excited about that general direction because I think the failure of standalone insurance, etc., just simply means that we've not found the right frame to deliver these services. And we may need to go beyond the traditional ways in which we've thought about products. So certainly our view is that the next wave of success in this space will come from a much deeper understanding of customer needs, and building tailored financial services, and not so much, I think, the whole let's build access, let's build this product and they will come mindset that is very, very supply side driven. So I think that's going to make a big difference, and I'm really excited to see some of the product innovations that will come from everybody in this community.
Thank you so much, Pindo. Mike, I want to come to you for the same question. So your company, the organization, just raised several millions of dollars to invest, in ideas like this in emerging markets and across the global south broadly. How are you thinking about, moving people and clients generally through that journey, through resilience, to access financial services? What has been the things that has worked so far, and the things that you think, you want to double down on going forward?
Sometimes when we talk about resilience, we do tend to focus on insurance but obviously anything you can do to help the income and help the savings of poor people around the world is going to help in resilience. The work of Accion, in addition to supporting the Center for Financial Inclusion, the work of Accion is largely investing and advising very early stage fintechs, as well as the incumbent financial service providers. Over our history, we've helped to build 285 financial service providers in 77 countries that are today reaching hundreds of millions of people. If you think about the revolution of UPI in India and PIX in Brazil, and the digital public infrastructure movement, a lot of our work is to invest in and build the higher level financial services that will ride on those payment rails. We're seeing spectacular innovation. We just closed a more than $60 million early stage fintech fund specifically to invest in some of the innovation that we're seeing. And you're seeing Field Intelligence is the fastest growing medical supply chain company on the continent of Africa, and they're embedding finance to help small mom and pop pharmacies. We're seeing Pula leverage global satellite data to ensure smallholder farmers across 20 countries across the continent. We're seeing Flowcart use WhatsApp to build business tools in new ways that are meeting the customers where they are. The innovation, part of why we focus on very early stage fintechs is because that's where the innovation happens. At the same time, we work with much larger institutions, the banks, the MFIs, to help them digitally transform and take advantage of all the extraordinary innovation that's changing all of our lives. We work very, very closely with MasterCard Center for Inclusive Growth, which has supported us in helping to bring 23 million people across 25 countries into the digital economy by digitally transforming the incumbents. It's very, very important work. And you're seeing a lot more uptake now in this new world with generative AI, and people are really eager. For many years, people talked about digital transformation. Now you can't even begin to have this conversation until you dive into digital transformation. It's critical. It's the way we're reaching our clients. It's the way we'll continue to expand financial inclusion.
Thank you so much, Michael, for that. Really appreciate it. Sophie, I want to come back to you and the Access Impact Pathfinder, and also, from that outcomes-driven approach that your organization, CGAP, pursues. What have you seen that has worked so far in terms of moving people along in this same conversation about resilience, and what have you seen that still needs a bit of work to accelerate the growth or the access to financial inclusion services?
Thanks a lot. Yes, so moving really not just people, but really the industry as a whole, from a focus on access to financial services to really unleashing the power of financial inclusion for development outcomes has been at the heart of CGAP's work for the last 2 years. We have this big initiative, which we've called Financial Inclusion 2.0, that is aimed at doing just that. And we've done a few things as part of this initiative. The first one that you mentioned is indeed with launching the Impact Pathfinder, which is an open space platform that identifies, based on available quality evidence, how financial inclusion can contribute to increased resilience, financial health, access to services such as health, education, etc., entrepreneurship, jobs, ultimately prosperity, because we wanted to really understand, how much can we hope that financial inclusion can make a difference. Then on that basis, we've been doing a lot of global advocacy to encourage all stakeholders to set their goals in terms of these development outcomes. And I think it's really ever more important than in the past, because we're getting so much progress on financial inclusion, but not on outcomes yet. One thing we're doing at the moment is developing a set of indicators at the outcome level to help investors, financial institutions, government really set their compass in terms of outcomes. And one of the first sets of indicators will be on financial health, and it will be shared at the meeting that Her Majesty Queen Maxima mentioned at the BIS in November. But maybe more importantly to your question, we've also been focusing our own work on identifying solutions to increase the outcome of financial inclusion. I'll just cite a few things that are super important in our view. One is climate adaptation and resilience. I think Leora mentioned the new numbers from Findex that show that 1 in 4 people in the world have personally experienced a climate event, and 75% of those have suffered a loss of income or asset. That's from Findex itself. But there is a scarcity of financial products designed to meet the adaptation needs of low-income populations. Inclusive insurance is lagging behind, and bundling is needed, as well as digital innovation, maybe linking insurance with remittances, for instance. Adaptation loan products are also needed, such as contingent credit lines that can help people prepare for a loan, or have the confidence that prepare for a shock, or have the confidence that if a shock happens, they will have enough finances available, which leads therefore to higher cultivation, higher productivity, because you eliminate some of the risks. So climate is one key area that we're working on. The other one that I want to mention is women economic empowerment, because while there's been a very large progress, we also see, I think Michael mentioned it, that in 20 countries, the gender gap is still over 10%. And in many of these countries, it has been stagnant. And so really understanding the root causes of these gaps and making specific progress in this area is very important. I think Leora mentioned problems in connectivity gaps for women. But beyond that, gender norms often come in the way of women's financial inclusion, agency, and resilience. And so we've just published a whole body of work to help financial institutions, regulators, investors really understand what is preventing women in certain given environments from accessing and benefiting from financial services, and developing products tailored to their needs, leveraging data and AI, providing more gender disaggregated data in the first place, creating cultures, regulations that are not gender neutral, but intentionally targeting women. All of this is incredibly necessary. Maybe one last point, I want to build on something that Bindu said at the beginning. I think the credit market also has a lot to gain and not to develop. And especially if you think about job creation, entrepreneurship, filling the SME finance gaps as really important objective for all of us. What we see in the Impact Pathfinder is that credit is very short-term, it's very small in value for many of these small firms. A lot is informal with high cost, low protection. And really what they need is a different sort of credit so that they can really have a step change in their production, in their productivity, in their digitization journey, etc. And so really deepening the credit market for low-income individuals and small firms, and leveraging AI, again, digitization, new credit scoring system. That is also a priority going forward.
Thank you so much, Sophie, for that. Leora, I want to come back to you now. One of the key things, one of the key additions to this year's Global Findex report, index, actually, is the digital connectivity tracker. Sophie mentioned a bit of this, just a few moments ago. But I'm curious about what are some of the things that stood out in this particular tracker, which captures mobile phone ownership and internet usage. Are there any things that you saw that were quite interesting and useful and instructive for how financial services providers across the world should think about when it comes to like providing access to their tools to consumers across these markets?
Yes. So we're very excited about this new digital connectivity module, which directly links to Michael and Sophie's discussion around both gender gaps as well as improving access to could improve access to business credit. So this new data, it gives us a better picture of how people are engaging with technology. So we find that mobile phone ownership is almost universal, but the gaps do exist, especially for women and even more so for low-income adults, especially in South Asia and Sub-Saharan Africa. So globally, we find that women are 9 percentage points less likely to own a smartphone, and that matters because 90% of internet users we find go online through their mobile phones. And basic phones may be enough for mobile money, but the real divide now is around smartphone access. And that's what lets people move beyond just texting to online learning, jobs, e-commerce, and government services, as well as digital payments. So for example, we find that about 20% of adults in developing countries are accessing government services, information online, about a quarter are accessing online learning. E-commerce is much lower, although we find more than 12% of adults across all East Asian countries earning income online using an app or website. But that's contingent on having a phone and having your own phone and being able to use it responsibly. And again, we're seeing affordability of handsets and the data remaining the top barrier, which is important. Smartphones are expensive household assets, and women are being left behind. We also asked about digital safety. Many adults reported being exposed to scams or not knowing how to secure their phones with a password. About almost half of adults in Sub-Saharan Africa with a mobile money account don't have a password on their phone. And even if the mobile money account has a PIN number, we do hear it reported that makes it easier for even someone they know to steal from their account. And linking it back to linking it all back to business credit. Sophie and CGAP are doing good work on this as well. When people have phones that they can use to make payments at merchants directly using their phone, that creates a real-time information on sales performance that's increasingly being used by lenders to provide cash flow lending, and even diverting the money from the payment provider directly to the lenders can also reduce the recourse risk. And so, developing this digital ecosystem, which first and foremost requires access to the devices and then the affordable and appropriate products, can really digitize the ecosystem. And even bring in one more point around resilience. One of the questions we ask is, if you've suffered an extreme weather event, did you lose access to your account? And the countries where we do see high numbers of those not only exposed to weather events, but also where you can't buy your groceries using your phone or card. If you have to travel to the bank after a flood to get your money to buy your groceries, you're not going to save your money in the bank. And so the development of the ecosystem can really help people also build resilience. Really, so I would say the key takeaway from the data is that closing the digital gap isn't only broadband coverage. It's also about the affordable devices, the user-friendly designs of the software, and also improving digital literacy so that more women and low-income adults can fully benefit from these digital and financial tools.
Thank you so much, Leora, and also for bringing up the data safety conversation too, which is a big concern as fintechs become more ubiquitous on African continent, in LATAM and also in South Asia too. Michael, I want to come to you now. There's a question that we have in the, from our participants, and it also ties closely to something that we're also curious about. So, how can providers, fintech, and other financial services providers and regulators work closely to create solutions that build trust among people in the global South who already distrust, any form of digital channels with their money? For example, Leora just mentioned some pattern of behavior that some people might have that affects how they're able to, save their funds in a bank in an event of a disaster. I'm curious about what you think about when it comes to partnership between regulators and providers. And it also ties closely to one of the questions that we have in the chat around how microfinance institutions in Ethiopia are being, I believe it's, what is the future of microfinancial institutions in the broader context of financial inclusion in markets like Ethiopia, for example?
So a couple of points in there. First of all, I have enormous sympathy. I was a regulator for a couple of years. Being a regulator is very hard. Being a regulator at a time when innovation is moving as fast as it is extraordinarily hard. It's really difficult to keep up. I do think discussions like this and forums like AFI and others or the Responsible Finance Forum are good ways for regulators to come together and share knowledge. Some of the themes that have already come up, the digital divide, there are places where there's still no electricity, no connectivity, lack of mobile phones. We touched a little bit on the fraud and scams. We didn't really mention the bias. There can be bias inherent in algorithms. Algorithms, on the one hand, can allow us to really reach people we've never reached before, but we need to make sure that we're doing that in a very inclusive way. I think the regulators, you talked about trust. I often think about moving people from the cash world to the digital world is an enormous leap. If I told you that I was going to pay your salary in crypto, you'd say, you'd have a bunch of questions like, okay, what do I do with it? How do I handle it? Is it safe? Am I really, can I buy things with it? That's the same journey that someone has to go through when you're going from cash to digital. Now, that said, we've made great progress, but there's much, much more work to do. And it is all about trust. And those first transactions are critical. If they work, you start to build trust. If they don't work, you start to lose trust. You mentioned Ethiopia, and the question in the chat was a little bit about microfinance institutions becoming commercial banks. We're actually doing a lot of work in Ethiopia. We're working with Dashin Bank, one of the largest banks, to help them digitally transform and better serve people who are left out. So I look, on the one hand, the whole financial inclusion movement is because banks don't reach this sector. So that's exactly what we're trying to fix. But I do think many banks are trying to leverage technology and trying to digitally transform and trying to reach people who've been left out. We're also, Ethiopia in particular, the last several years, he just stepped down, but the central bank governor has been quite the pioneer in really building the right regulatory structure. And we're seeing innovative fintechs like Kafia is one of the most sophisticated users of alternative data to help smallholder farmers. So there's a lot of innovation in places that you might not guess. I do think commercial banks haven't been the. I think they're trying, but they're not really set up. I think the fintech innovation can fill in great areas where the banks may not get to.
Thanks so much, Michael. And you touched on something very crucial there at that last bit about how the pace of innovation with the traditional banks and the fintechs, and obviously the fintechs tend to move very quickly and make innovation available to consumers. Bino, I want to come to you. Michael already touched on a few of this, but I want to get your thoughts on it. So your organization uses digital technology to reach people who are often, again, not familiar with digital tools. They don't trust it very much, particularly in Asia, for example. How are you using algorithms and AI, for example, to mitigate some of the potential biases that people have towards technology in this market?
Sure. Let me answer this a little bit from a broader markets perspective and then come back to Dwara. I mean, clearly, as Michael said, digital is everywhere. In India, 1 out of 2 Indians, made or received a digital payment in the last year, and that number is growing dramatically. Almost every financial institution, including ours, is using AI in some manner. We are using it for everything from uniquely identifying cattle in an insurance context, to fraud identification, to chatbots for grievance redress, right? I mean, I think the range of applications is exponentially growing. And as Michael said, I think not surprising that guardrails will lag behind. Some recent work by our central bank, the RBI, found that only about 15% of financial institutions who use AI use any sort of explainability or interpretation tools in terms of what they're using, and very few are, at least right now, validating for things like bias and fairness. So all of that seems, really in some sense early days. However, I think given all of that, customer protection, I think more important than ever. In fact, some of my colleagues at Dwara Research, they did an interesting study in which they presented customers with journeys of formal kind of genuine lenders and rogue players. And turned out that customers tended to trust journeys of rogue players a lot more because they really sort of perfected the art of what are the key kind of points to emphasize in the journey. So all of that is worrying at some level, and obviously we don't want to stall progress, but I think it's important that we have new ways to think about conduct regulations in particular. That's something that I think is going to be really important, and we can't leave it to the customer to sort of go through this maze, identify who are genuine providers, what are genuine transactions. And just to briefly share, I think some of the ideas coming out of our research, I think one, definitely moving privacy away from a pure consent only model that is simple but not always effective, to a model that is activated by customer consent, of course, but happens in an environment where privacy can be guaranteed, and there has to be more onus on the provider around some of those issues. The second one, which is a really live issue for us in India, a lot of our progress in account opening happened in the last decade and shows up in the data, of course. A bunch of those accounts that were opened in 2014 come up for re-KYC this year. And I think there's a real question of how is all of that going to happen, and are we going to have a little bit of a set of dormancy arising from the re-KYC process. But just moving KYC away from customers sort of submitting information at periodic intervals to really using more continuous transaction account monitoring, and sort of saying that it's not a once in 10-year process, it's continuous, and customer interventions with respect to KYC are only in response to certain triggers. So it really feels like these are some of the areas where it'd be fantastic to have more kind of innovation, because otherwise I think some of the gains are at risk. Some of the things that we've done in our market, we worked, my colleagues in the research side have worked on a market monitoring tool to help uncover customer-facing issues in digital payment transactions. So this tool sort of scrapes data from social media, Google Play Store, specifically for providers with a lot of transaction intensity, and then uses natural language processing to categorize issues. And we think tools like these are going to be very, very relevant in the supervisory toolkit, because things are happening so quickly, you can't wait for the more traditional supervisory cycles to identify issues, address them, and so on. And kind of the final thing that we are doing, I'm very excited about, is that we have in India built a center for AI and financial inclusion within an Indian university. And we are developing what we think are meaningful use cases and prototypes for financial services providers, including MFIs, who may otherwise sort of lag behind in adoption. And I think it's super important that people with customer understanding, people with the financial inclusion domain knowledge kind of drive this conversation so that we get applications that are genuinely relevant.
Thank you so much, Bindu, for that. That is real deep and very rich too, in terms of how you leveraging AI at this early stage of its own development for finance. We have 5 minutes left. I want to give our speakers, our great speakers, if you roughly 30, 45 seconds to, is there anything that you've heard from your co-panelists today as main takeaways that you think has inspired you for further action to drive financial inclusion in your own various capacities? I'm going to start with you, Michael, and then I'll go around the room.
So not a surprise, Sophie said something that was enormously powerful and important. This is no time for complacency. We're celebrating great progress over the last decade, but the pace of progress is slowing. Reaching and serving the next billion is going to be much harder than the last billion. And so we need to redouble our efforts. And of course, that's just access. We need to move beyond access and usage and make sure that the products and services that we're building truly benefit people. I'll stop there.
Thanks so much, Michael. Leora?
So first, my real sincere and tremendous thanks to Michael and CFI for featuring the Findex data. It's really a pleasure working with CFI and organizations around the world. Use the data to design the right products and policies. I was struck by something Bindu said about the importance of user-centric products. One of the amazing findings we find today in Findex was that a quarter of all women in India are receiving government payment directly into her account, but very few are using it to make payments, especially merchant payments or paying bills, etc. And how can we design the products that women need to help them build their financial lives?
Thank you so much, Leora. Sophie?
Yeah, so for me, it's really about leveraging digital data and especially AI to fill the last mile gaps, but also to increase access and usage of the other financial products that are really necessary for people to be fully financially healthy and prosperous: insurance, credit, the types of credits that they need to grow their businesses, to build resilience, more savings as we discussed, and also pension for the long term. But doing this while strengthening consumer protection framework, in fact, really rethinking them so that we create an ecosystem where everybody behave responsibly, collaborates, monitors risk in a much more proactive manner and consistent manner, as Bindu said, and where consumers have redress mechanism, are digitally educated, and where regulators also have the tools and expertise to support this safer environment. So data, but consumer protection at the same time.
Thank you so much, Sophie. Bindu?
More than a specific idea, I'll just say that really energized by the optimism in this panel, and good reminder that I need to talk to Michael and Sophie more often. I tend to be a bit more glass half empty, so it was wonderful, and I take away that sense of optimism to keep building, to keep sort of working on what 10 years ago seemed like intractable issues. And thanks, Abubakar, for this great conversation.
Thank you so much, everybody, for joining this panel. Thank you, Michael, Sophie, Leora, Bindu, for sharing your expertise and the work that you've been doing. Really, really fascinating work. And obviously, we have the rest of the week to discuss financial inclusion. And thank you so much to the Center for Financial Inclusion that is hosting today this event for this week. We're going to be having a lot more exciting panels discussing this topic and digging deeper into the main takeaways, on how to drive financial inclusion across the world. Please stick around, and thank you so much for being a part of this panel. Bye for now.
Thank you.
Thank you.
Great. Thank you.